And welcome. This is Mansoor Sharif here. Today in this video, uh, I'm going to cover a very important accounting standards that define how business report their financial health, which is IFRS 15, which focuses on revenue from contracts with customers. This standard is critically important because it directly impacts profit measurement, valuation of the businesses, and the overall reliability of their financial statement. In this IFRS, we will try to cover the scope of the IFRS 15, the purpose of the IFRS 15. There are five-step revenue model which we will try to understand uh, step by step wise. Through an example, we will try to understand this IFRS 15. And lastly, the exam focus which student faces, we will try to cover these steps in this video. Before going to into the much detail of the IFRS 15, first we will try to understand why revenue is important, why revenue matters. As we all know, revenue is the top line of the income statement. It drives the profit of the company. It influences how investors value our company. If revenue is recorded at the wrong time, either too early or too late, it can mislead user financial statement. IFRS 15 is the standard that fixes this issue. It ensures that every company recognizes revenue fairly and consistently. Answering this question, when do we book it, how much it is, and what risks are involved? All these questions we will try to answer in this IFRS 15. As we all know, revenue is the ultimate goal of a business. Revenue reflects the true value of a company. Revenue indicates the profitability of the company. Revenue drives the growth. Revenue is the key performance indicator of any company. Next, we will try to define the revenue. So, what's the main rule here? Under the old rule system, revenue was often about when the risk and rewards transfer to the customer. But under IFRS 15, the focus is on the control of assets or the services. The core principle is that you should only recognize revenue when the customer gets control of the goods or services. This is an important shift from old system to the new IFRS 15, as it's not about when we deal the contract or when we sign the contract, but when the customer actually calls the product their own, that it's my contract, it's my product, or it's my services, then we can define it as it's my revenue. Next, we have the scope of IFRS 15. IFRS 15 applies to the most contract with customers. This include the sale of their goods, the rendering of services, construction, and the long-term contracts and contracts involving multiple deliverables. This broad scope ensures that revenue recognition is consistent across different industries. Next, we have what are the things which are excluded from the scope of IFRS 15. However, IFRS 15 does not apply to everything. Uh, Lease contracts are covered under IFRS 16, insurance contract under IFRS 17, financial instrument under IFRS 9. It also excludes certain non-monetary exchange between entities. These exclusions prevent overlap between accounting standards. After this, we will try to understand the main core principle of IFRS 15. The core principle of IFRS 15 is that revenue should be recognized when a performance obligation is satisfied. This occurs when the control passes to the customers. Revenue may be recognized either at the point in time or over time, depending the nature of that contract. This is the main core principle of IFRS 15. Next, we have the measurement, how we will measure the IFRS 15. in values. Revenue is measured at the transaction prices. This includes variable consideration such as discounts or refunds, but it excludes the sale taxes collected on behalf of the government. Next, we have the presentation and disclosure of IFRS 15. Revenue should be presented net of discounts. IFRS 15 also requires detailed disclosures, including disaggregation of revenue, contract balances, significant judgment used in applying this IFRS 15. Next, we have the five-step revenue model. We will try to understand this. Uh, to make sure everyone applies this logic correctly, IFRS 15 gives us a roadmap. It's called a five-step model. We have to follow these steps in order, but in order wise. Firstly, we have identify the contract with a customer. Second, identify the performance obligation in the contract. Third step is determining the transaction prices. Step number four is the allocation of the transaction price to the performance obligation in the contract. The last step, step number five, recognize revenue when or as an entity satisfy a performance obligation. These are the five-step model. Now we will look into these five step by step wise. Step number one. In step number one, a contract must be approved by all parties, have a clearly defined rights and payment terms, have commercial substances, and collection of consideration must be probable. Should be no ambiguity in the collection period. The contract can be oral, but in majority of the time, the contract is in written form. This is the step one of the five-step model of revenue recognition. Step number two, the performance obligation. A performance obligation is a promise to transfer a distinct goods or services. A goods or service is considered distinct if the customer can benefit from it separately or it is a separately identifiable with the contract. Like we have here, uh, we are providing goods to any entity or we are providing any services to an entity. The performance obligation is identifiable. Step number three, determination of the transaction prices. The transaction price is the amount of consideration expected from this entity, from the entity which we are delivering products or services. It includes estimates of variable consideration, but it only applies constraints to avoid revenue reversal. Next, we have step number four, the allocation of transaction prices. The transaction price is allocated to the performance obligation based on the standalone selling price, which may be estimated using market-based or cost-plus approach basis. We will try to cover this IFRS 15 through an example. Then we will hopefully understand all these processes. Finally, step number five, revenue recognition. This is all about the timing. We recognize revenue when we satisfy the obligation. This happens in one or two ways. First is over time. This is for things like a cleaning service or building a road where the customer benefits you as you work. The second option is at a point in time. This is the selling a product. This is for selling a product like car. The revenue hits the book the exact amount when the keys are handed over to the customer or the control is passed to the customer. Let's try to understand IFRS 15 through this example. Here the input tab. Here we have defined the basic assumption of this example. The standalone selling price of a shoe is 100 and the standalone selling price of the socks are 20. The bundle price offered to the customer is 100. Although socks are mentioned as free when we purchase the shoes or the jogger, but under IFRS 15 they are treated as a separate performance obligation. This input will be used. This input tab will be used in the next for the allocation of the revenue, which we will cover here in the next step. Uh, in this step, the transaction price is allocated based on the standalone selling price. First, we will calculate the total standalone selling price here, which is 120. Uh, in this total standalone selling price, the shoes ratio represent the 83.33% and the socks represent the 16.7 uh, 67% rupees to allocate to the socks. This allocation follow the core requirement of IFRS 15 when the performance obligation will be held, then these prices we will record in our revenue book. Next, in the revenue schedule tab, here this tab explains when revenue is recognized. Revenue related to the shoes is recognized immediately because the shoes are delivered at the point of sale. However, socks are delivered later, so the revenue related to the socks is deferred. The deferred amount is not recognized as revenue until the socks are delivered to the customers. Here we will record the revenue from the socks at the 1st January 2026 as a contract liability at the ending. In the next day, we will when we deliver the stocks, when the customer receive the stocks, then we will record this 16.67. Next, we will try to understand how we will pass the journal entry for this example. At the time of sale, the cash of 100 rupees is received here. Revenue for shoes amounting 83.33 is credited. The remaining 16.67 is recorded as a contract liability for the socks. When the socks are delivered, the contract liability is debited and the revenue for the socks is credited. This ensures revenue is recognized only when the performance obligation is satisfied. Finally, I move to the ledger tab. This tab summarizes all the ledgers balances derived from the journal entries. It shows that cash is correctly recorded, revenue is properly recognized, and the contract liability becomes zero after delivery of the stocks. This confirms the accuracy of IFRS 15 accounting treatment. Uh, to conclude this Excel file, it complete the demonstration of IFRS 15 for a bundle sale. It covers identification of performance obligation, allocation of transaction prices, timing of revenue recognition, and correct journal entries. After this example, now we will move to the exam focus point. For those students who are preparing for exam, they should be careful for the common traps which they face in the exam. Usually, they confuse with receiving cash with earning revenues. As revenue and cash are not equal, they should don't ignore the multiple performance obligation in a bundle contract like we have looked into the example before, and never recognize revenue before controls actually transfer. This is the golden rule. We have to understand, we have to remind it. To conclude uh, this IFRS 15, we have a recap, of a strong recap we have. To wrap up the IFRS 15, remember the keywords: the control. Revenue is recognized when the control transfer. We must we must use the five-step model, and getting the timing right is essential for accurate reporting. This is all about IFRS 15. Thank you so much for listening.